bring in Diane King Hall, who's with us to go over some of the names and movers on earnings. We were just moments ago talking about Macy's.
I heard,
Tell us some more details, Diane.
So it looks like it's really about kind of the caution going forward, why shares are falling a little bit. Because listen, Macy's had a strong quarter, the strongest sales growth in more than 3 years. Adjusted EPS coming in at 9 cents per share. The street was expecting a loss, so they're in the black there. Revenue topping $4.7 billion. That also is better than expected. It had improving comps. They've been working on this turnaround strategy that is just continuing to gain traction. They did lift their full year sales and earnings outlook. This is for the second quarter in a row that they've lifted that. Here's their new EPS guidance. They're guiding for between 2 to 220. That's up from 170 to 205. That's the full year outlook. Full year sales, they're now expecting that to come in between 21.4 and 21.63 billion. Now shares are falling as they just kind of have more caution around the holidays. They talked about consumers are being selective. We've heard that sentiment within the retail sector in general, the choosy consumer. So in the most recent quarter, yes, there was still spending happening within the Macy's banner. And of course, that includes Bloomingdale's and Blue Mercury along with its namesake brand. But what they're noticing is that there is still selective spending happening. There's tariffs still at play here, which is a risk factor for Macy's. And they talked about a still pressured aspirational consumer. Now, what was the standout, Nicole? Bloomingdale's. Huge numbers there, 9% growth there in terms of comps. So that was strong. Blue Mercury had some strength, up just 1.1%. The Macy's namesake brand is improving, but they're still playing catch up there because they've been working on store closures there, and that's expected to weigh on total revenue as they continue to right that ship.
You know, I love Diane. And
yes.
Diane loves me. And
yes.
this is behind the scenes, BTS
yes.
for you. She said, you know what was the bright spot? Nicole?
Yes.
Bloomingdale.
Yes.
Because I love Bloomingdale. It's pretty much the only place I shop. So she's 100% correct. If you didn't know, you didn't know. But now you know. CrowdStrike is down 4%. Let's talk about that.
And I think part of that, because listen, CrowdStrike did do better than expected. Part of that is just going into this. Expectations were high. The stock has been an outperformer year to date. They did deliver on the results. Adjusted EPS coming in at 96 cents versus the 94 cents the street was expecting. So a little better than expected. Revenue coming in at 1.23 billion. That was also a beat. They did deliver an upbeat forecast for Q4, but clearly not enough to just wow investors. They credit strong demand for its AI-powered cybersecurity tools. They've been layering new AI features on its Falcon platform, including just automated detection, some tools around triage that gives the customers just more efficient protection there. CrowdStrike has been scaling. Analysts see it as scaling efficiently here. They are obviously leaning into AI. Their Q4 revenue guidance, they're guiding for between 1.29 billion to 1.3 billion. That's actually above what Wall Street's expecting, but there may be some whisper numbers, especially when you think about adjusted EPS there. They did their full year revenue outlook. They raised that to 4.8 to 4.81 billion. So there is some momentum there, increasing momentum there. They're seeing strong subscription trends. Investors were really looking in. Key data point, annual recurring revenue. That rose 23% to nearly 4.92 billion. So they have overarching strength, but maybe not enough to warrant investors dipping in more, especially given the momentum that it's had so far this year.
On the higher end of the price targets, I mean, Goldman Sachs is right there with Goldman Sachs has a 564. I did see Rosenblatt with a 630 price target, BTIG 640 price target. So there is a lot of optimism from Wall Street for this name going forward. Last but not least, Okta.
Yes, it's out with its quarterly results. They did do better than expected on the trailing quarter. Adjusted EPS coming in at 82 cents. The street was looking for 75 cents. Revenue came in at 742 million. The street was looking for 730 million. Shares are a little off today. That stock has really just been not done a lot so far this year because investors have clearly found better opportunities elsewhere. Again, total revenue grew 12%. Subscription revenue was up 11%. Their free cash flow jumped to 211 million. That's up from 154 million a year ago. Their remaining performance obligations, RPOs, rose 17%. That's essentially their subscription backlog. That did top forecast. There is momentum around AI, but there are high expectations going into this. Investors just want, here's the other thing, they didn't give fiscal 2027 guidance. They withheld that. They cited this need for conservatism if they were to give it, so they withheld that, and the street is punishing them for that.
Yeah, and of the three names, this is the name you didn't want this year. It's down.
Yeah.
I'm sorry, it's flat. I think year to date, Okta is 3%.
Yeah, it's down.
Yeah. It's actually up. It's up
year to
3%
date?
year to date.
Okay.
I don't know, maybe.
No, you're right. You're right.
But
you're
here,
right.
the
you're
other
right.
two, when I was saying, like, that's the one you probably didn't want. Macy's, when you weren't looking, right? That's
I
up
know.
32%, and CrowdStrike's up 47%.
Yeah.
So if you wanted 2 out of 3, you'd take the first 2, not
It's
the
true.
last one.
Absolutely.
Diane, great to see you.
It's good to be with you.
And by the way, our computers are constantly updating, so sometimes we have to check each other all the time. All right, thank you, Diane. Great to see you.